I'm very pleased to be here. I'm particularly pleased this week because it's the first week I'm walking after about 7 months. I have two of my colleagues here, both who are future MBAs, Evan Morgan and Dan Bowles, and I have a family member somewhere hidden in the audience, so you can kind of try and figure that out. Good. Let me just, I don't want to dwell on my career, let me just make a couple comments because I come to private equity from a slightly different route. After graduating from school, where I have to say Tom Robertson was my marketing professor and advisor, I joined T. Rowe Price when it had less than 50 employees and less than $500 million. Today it has $450 billion, so it tells you how the industry has grown. And then we were very active in starting a firm called New Enterprise Associates, which I think is the largest venture capital firm by far. And then in 1986, we started the Carlyle Group. And we started it, this seems ridiculous today, with $5 million. And the money was allocated $2 million for working capital and $3 million for investment. And the idea was that the investors, one of whom was the Mellon family, whom I knew, did not want to be diluted, so that they made some of the money be allocated for deals. So I come to this business with both a public and a private market background. Now you should have 3 handouts. One is a copy of the charts we're going to look at today. Secondly, I hope you got a Carlisle annual report. And thirdly, each year for the last, say, over 20 years, I have done an investment report on the industry. And I'd say a third of the people throw it away, think it's ridiculous, a third really like it, and a third don't care. But it's been a way for me to keep in touch with people and build relationships over time. And one of the things I'm going to stress is the importance of that in our business. Let me turn now and speak a little bit about the Carlyle Group. This is going to be kind of a cook's tour. We're going to go through private equity very quickly. And if any of you have questions or if you want me to dwell on something, just raise your hand and hopefully I'll see it, or Evan or Dan. They'll each take half of the room and we'll do it. Let's talk a little bit about Carlyle. As I said, we started in 1986 with $5 million, 3 of which we could invest, and kind of lived by our wits for a while. Today we have $86 billion. We have 67 funds. We operate around the world. We have 1,300 investors, and we have almost 1,000 employees, about 400 of which are investment professionals. And as you look at the industry, you'll see that each of the major firms has a different strategy. I'm not going to comment on the others. If you want, I could speak about it later. But ours is people on the ground and diverse offices, and our funds are semi-autonomous. And so the Japanese fund or the Middle Eastern fund or the European fund basically are people on the ground in their locations, but to borrow a phrase from Woodward and Bernstein, follow the money. I don't know if any of you remember that from the Nixon days. But so every investment decision comes through the central office. Oh, I'm going the wrong way here. And what we do, I'm going to focus first because I think it's the most important on the investment committees. But each fund has an investment committee with people in the Washington office. Senior investment professionals sit on it. And it's more like a capital commitments committee of a brokerage firm. And we don't exhaustively review the due diligence, but we look at every deal to see if it makes sense. And there has to be approval, no matter what, from the investment committee. As we've grown, you can see we've developed quite a bureaucracy. That's my term. And all these are areas that have a tremendous impact on the firm. And one of the real problems today, and I guess this has always been true, as if you're a larger firm, you have to fight the bureaucracy every day to keep the entrepreneurial spirit. So, I mean, we have external affairs, legal, things that you probably don't think about, the Foreign Corrupt Practices Act, contracts, etc. It gets fairly complicated. On the investment side, we divide ourselves up not just geographically, by function. We have a buyout group, we have a growth or expansion capital, we have leveraged finance, we have real estate. One thing that's missing here, or 2 things that are missing that a Blackstone would have, are one, the advisory business, which we are not going to go in. The other is the asset management business. And that would be whether it be hedge funds, public securities, or whatever. This is, you may laugh at this, but one of the important things in investments is to stand back and ask what's going on, and there's some enduring truths, and I'm not going to go through every one of these, but I think as you look at careers and look at investments and look at companies, that if you ask yourself some of these questions, it might improve your decision making. And the reason I highlight this is we have gone through a tremendous cycle in our business where money followed performance. We think excess capital drove down returns. Size definitely has an impact. Notoriety. Regression to the mean is a very powerful force, and when you look at some charts, if the numbers look unsustainable, they probably are. And the people have said the most dangerous phrase in investing is it's different this time. Now, I am going to tell you some reasons as we go down why it's different, but I think these are things that are important to keep in mind. And as you think about private equity or alternative assets, they're part and parcel of the financial system. They do not operate in a vacuum. And what happens in the financial markets influences us. We don't influence it to any great extent. A couple things I want to highlight. I'm not going to walk you through this whole chart. But we know now there's enough data. People talk about earning 4 and 5 and 10 times their money. We know now, whether it be venture capital, real estate, private equity, if you return to the investor 2 times their invested capital, you're a very successful fund. Certainly top quartile, maybe top decile. So that's where you want to get. Now, these numbers, as Evan has pointed out to me many times, do not allow for the staging in of investments. But if you take the money day one and you want to earn 2 times, you can see what happens, how it goes down with the holding period. And in private equity, there's another factor that you have to make up for is we have to pay back the fees. And we have hurdle rates at 8%, and the fees compound at 8%. And when you take deal fees, investment management fees, et cetera, you create yourself quite a hurdle if you don't start returning capital. Most of our clients look at the IRR today, which is, in my opinion, a fallacious number, but we're starting to see people think more about money in, money out, the way people have traditionally talked about real estate. So this is something you should keep on your desk, along with this. You know, remember Warren Buffett's rule? First rule is don't lose money, and second rule, don't ignore the first rule. If you have a wipeout in a private equity portfolio, it is very difficult to make up. Venture, they claim it's not so difficult because you have some big hits, and we'll talk about that in a minute. But this is just arithmetic, but it's very powerful. You know, private equity and venture capital have at times gotten tremendous publicity. I just wanted to kind of put in perspective where they stand relative to the financial markets. And this is just the U.S. market, as you know, the U.S. stock market is probably about 40% of the total. Do you know what the number 2 market is, financial market, stock market is in capita these days? It's China. But you can see the major stock exchanges, Evan, these are the right numbers, 15 billion. Stock funds of mutual funds, 4.7. Hedge funds, somewhere around 2 trillion with leverage. Private equity, we're not sure exact number, but something like this. And then you get down to venture capital, which is infinitesimal. So within the scope of the financial markets, these are not huge assets. And I thought I'd just take a look at market caps of certain companies. So you can see Exxon has a market cap that's bigger than the venture capital business. Microsoft's cash is 2 times what venture capital raises a year. And again, we could play around with these numbers and talk about it, but it's just for perspective. So a Cisco is a much more active venture capital investor, really, than anyone else, if you look at the money they have. So let's talk a little bit about private equity now, having that in perspective. We went through what I would call the perfect storm that the numbers aren't firm, but it went from like 2002 to 2007. The returns looked tremendous, especially versus the stock market. There were tremendous amounts of cash paid back, again, primarily through recapitalizations. And this was a tremendous opportunity because interest rates were coming down and banks were lending more. So what you could do is refinance. you get a higher debt ratio and lower interest rates, and it was an enormous advantage. And of course, those days ended, but a lot of the returns came from recapitalizations. And I think it was in 2007 or 2008, 90% of the high yield market was recaps. One thing that people haven't recognized as an appeal of private equity is, for a financial institution, you're getting non-recourse leverage. If I went to the Penn Investment Committee and said, look, we'd like to lever up, we'd like to do an individual investment, we want Craig Carnegoli, the CFO, to take on $500 million in debt, I mean, he would shoot us. But when you get it through a private equity fund, it's an inherent way of building leverage into your portfolio, and people realize that. So as you had performance, you started to see increased allocations. We saw a lot of new investors, a very traditional pattern. Private equity became, the heroes of the era, and we've had other heroes, some of whom have crashed, but you saw Steve Schwartzman, David Rubenstein, David Bonderman, Henry Kravis on the front page of the papers. They were in the front page of, on the covers of Newsweek, et cetera, or Business Week. The industry started to institutionalize. When we started, we had primarily individual investors, a few small institutions, some fairly sophisticated people, some more international than others. But it started to spread to all institutions. So what you saw for our industry is a tremendous growth in assets. So like I said, we started with a $3 million fund. Our second fund was $100 million. I think our third was $500, and our last fund was $15 billion. So it was quite a change. I just want to spend a minute on how investors thought about this and what brought us into it. And a school like Penn, are you all familiar with the spending rule, how they think about how the endowment works? Is that something you've talked about? Or, in essence, a spending rule for Penn believes that they can spend about 4.5% of the endowment, that the capital market return will be about 8%, and that by reinvesting the money that you don't spend, you keep up with inflation. So you had a spending rule, and then pension funds, of course, have an actuarial assumption. The better that is, the less money they have to put in, so there's some interest in keeping that high. So what you ended up with was a situation where, rightfully or wrongly, people were not that excited about stocks. They weren't that excited about fixed income, and so they moved very dramatically to alternatives and diversifying assets, whether it be hedge funds, private equity, whatever. And firms like CalPERS were writing $250, $500 million checks to private equity firms. I mean, it was really quite staggering. When I was at T. Rowe Price, if we could pick up a $2 million account, we were really excited. And that was quite a change. And then people, of course, the whole strategy is you have to keep up with inflation, and people have varying views about that. Okay, you know what happened to the stock market. But again, this affects our business quite dramatically, because private equity, while the market was languishing, was showing very good returns. This has not been updated, and the numbers are very soft. But basically, what you have is that these types of assets were providing a much higher return than the NASDAQ or the S&P 500. Now, these numbers are nowhere near what people talk about, 30, 35%, 40%. I just want to make the point, again, you can look at this at your leisure. Financial crises are nothing new. Markets live and die with them. This time was maybe a little more onerous, but we've been through a lot of different ones over time. And again, each of these things we could spend a long time on. Okay, what happened? We went through a very difficult period. People's performance expectations changed quite a bit. Their risk tolerances and preferences changed. In good times, people are looking at the upside. In bad times, they're concerned about the downside. And there were tremendous changes in how investors looked at this. That private investments, when you go into a Carlyle fund or a KKR fund, in effect, you're locking your money up for 12 years. If you're with T. Rowe Price with an institutional common stock fund, you call that night, the bank transfers it over, and it's your money, you liquidate it next day, you can do it in Hong Kong, whatever, but you have your money right away. And the premium for locking money up for 12 years went up dramatically as a result of what people saw during this environment. The availability of bank lending just stopped. As you recall, the banks were just frozen. They had all these other problems. So people in our business could not get credit. It wasn't a question of price. It was just availability. Everyone stopped. Fundraising hit a wall. And we had dramatic, and you'll see some of the numbers. But what happened here is as the public market shrunk, people's percentage in private equity and hedge funds, et cetera, which were relatively stable, went up. They call it the denominator effect. And there was just a number that came out this week. Yale, and I think this is the correct number, has about a $14 billion portfolio. They have $7 billion of uncommitted capital calls from private equity and other funds. I mean, this is it just changes people's attitude and the way they invested. So firms like ours who had very large pools of capital ended up not being able to invest, which the clients then say, well, why are you sitting on our money? Why don't you return it? You know, the fees are being accrued, compounding, so you get yourself a real hurdle to get over. But if you look at the buyout business, which we'll see, there was virtually no investment made over a period of 18 months. And then finally, the phenomena of the buyers and the sellers were so far ahead on prices. I mean, we were looking at current conditions, having to put more equity in, what the price should be. The sellers were thinking about what the price might have been 2 years ago. And so that gulf has closed a little, and one side's going to have to capitulate. I think it's going to be us, but it hasn't happened yet. Okay, so what happened in private equity? There were fewer investments and smaller investments. Exits stopped, virtually no distributions, and historically, limited partners have thought that they're never going to invest more than 75% of what they allocate because you'll get money back to offset that. That stopped. Fundraising fell precipitously. Are you familiar with how the banks flex? They have certain latitude within the lending agreements. They all went to the max or they withdrew. I mean, there was a phrase that if you changed your seat at the table, it was a material adverse clause function, and it stopped, and people just withdrew from the market. We were dealing with covenant-light loans. I mean, there were nothing in the loans that could cause you problems, and one of the reasons we haven't had bankruptcies is because the loans were so covenant-light. The firms started thinking, how could they invest their money? They started looking at different deal parameters, and we're going to dwell on that in a minute, but historically, firms like ours did plain vanilla LBOs. You borrowed money, you bought a company, you paid down the debt, and you made a certain rate of return. Now you're starting to see minority investments, pipes, lots of different things, cabals of people together. But the other thing is that there were widespread fears of what was going to happen. I mean, 12 months ago, maybe 13 months ago, we were at the nadir. I mean, people thought the banks were going under, we were going to be out of business, I don't know, the endowments were done, I think the markets turned on, March 12th of last year, but I mean, it was a really rough period. And so you had all these fears. Now, this is just some of the great publicity that our industry has received at the time. For a break. This goes way back, Barbarians at the Gate. But this was an industry which was very quiet, wasn't very well known, and I think 3 or 4 things generated a lot of publicity. One was the returns. 2 was you had a number of the stars. 3, some of the deals started to have a much more pervasive impact than was the case heretofore. When KKR and TPG bought Texas Utilities, they had to deal with the rate commission. They had to deal with consumers. They had to deal with the lenders. They had to deal with the environmentalists. This was something, when you're doing small deals, you do not have to worry about those type of constituencies. Okay, but let's ask what didn't happen. there was a lot of talk that there was going to be widespread bankruptcies among the big deals that were done in 2007, 2008. It didn't happen. I'm not going to say it's not going to happen, but you're starting to see these things get refinanced. Some of them are so covenant light, the banks are going to, in 5 or 6 years, end up owning the companies, but there hasn't been the collateral damage that people predicted. You may have seen, like, Blackstone just refinanced Hilton. And there's a mountain of debt out there, but so far it hasn't happened. Secondly, people said that the general partners were going to default on their loans, on their investments. And have you talked at all about the onerous terms if you default? Okay, but basically, when you make a commitment to a private equity deal, heretofore, the terms have been extraordinarily favorable to the GP. So once you invest a certain amount of money, if you don't continue investing, the losses to you are onerous. Basically, they recapture. I won't go through all the details, but you recapture a portion of the money. There was a lot of talk and money raised for secondary sales. You may have read Stanford wanted to sell $1 billion, other firms. It just didn't happen. And one of the reasons it didn't happen is that there could be no agreement on price. The buyers thought that the sellers were in such distress that they made demands that were just unreasonable. And these are reasonably complicated deals because if you want to buy a piece of Carlisle 5, let's say I'm a seller, you're a buyer, you're not only buying the asset, but you are buying the obligation to continue the stream. You have to finance the rest of it. Also, that the GPs have put a very interesting clause in there that we have to approve any transfer. So if KKR were to have a secondary fund, we wouldn't be real anxious to sell them a piece of our fund. So for a lot of reasons, this didn't happen. There is still a massive amount of money out there geared for secondary purchases. And maybe if the prices go up, the market will do it. You may have seen China just committed $1.5 billion to this area. Okay, there was no implosion of private equity firms. There was a lot of talk of that. There was a lot of talk of government action, regulations. Again, there was a lot of talk. One of the problems now with taxing carried interest is there's no carried interest, and there's not going to be for a while. But there was talk of that. There was talk of making registration with the SEC, et cetera. It just, so far, it hasn't happened. There are some things on the horizon. You probably read about the Volcker rule. These things are very complex. I mean, how can you tell when Goldman Sachs is operating as a principal or as an agent? And when they lend to a company, if they're invested in it, I mean, it would be a real problem disaggregating that. Though it would be good for us if they could do it. There was a thought that the banks would just be stuck with these leveraged loan portfolios forever. It didn't happen. I don't know if you've watched what's happened in the credit markets, but the credit markets are up a staggering rate in the last 12 months. Probably the average credit is up 60, 70%. And it's been indiscriminate. It's not just the high quality, it's everything. There's been no sense that private equity contributes to systemic risk. I mean, we are not Citigroup or JP Morgan or someone that would contribute to that. There were some fears of that. And then thirdly, lastly, I don't think there's been an abandonment of private equity. You may have seen, for whatever reason, Yale just announced they're increasing their thing. We still see lots of interest. The form of the interest is changing, but there's still much, much interest. This is just the deals. I'm not going to go through these, but these are the deals. Most of the big deals in history, aside from RJR, were done in the last couple years. These are very large. This is, of course, Texas Utilities, which all of these have issues, but Hilton, but it looks like they're going to work out. Not to provide returns to the private equity, the investors, but not to go bankrupt. Let's look at fundraising. This goes way back. You can see on a quarterly basis. You can see by the year. And it probably correlates with performance and distribution. Now we're down to, a relatively small number compared to what we knew in these periods. And there's a lot. these numbers are indicative. They're kind of soft because they capture a lot of different kind of funds, but you can see the trends are pretty clear. The availability of leverage, you can see the heyday coming down. And these are factors that really influence our returns. Again, going way back, you weren't putting much equity in these deals at all. Today, you're up somewhere near 50%. And that gives the lenders a lot more support, but it also has to drive down the rates of return. And how many people here think the stock market will compound at 10% over the next 5 years? How many less? Okay, so if you think the stock market, let's pick 7. If you think the stock market is going to compound at 7, historically what people would say is I want 500 basis points above that for LBOs or venture, give or take. You know, you're talking 12% return expectation for the investor, not 35 or 40. But the issue then becomes, once we get down into that type of rate of return, we don't earn much money. The carry only becomes worthwhile if you have a high earnings rate. This is true for hedge funds, whatever. One of the things that we're seeing is that the investors are very interested in making sure that we're not earning money from fee income. I mean, the history, you all are familiar with how the economics of the funds? I mean, basically, we charge 2 and 20. Historically, that came about through venture capital when very small firms needed the 2%. People never envisioned you would be layering funds. So when you have Kleiner Perkins 12 or Carlisle 7, you're collecting fees on 5, 6, 7 funds, which means probably you can earn a fair amount of operating income. Clients perceive that as not in their best interest. And so there's going to be pressure in that regard. So for us, the real thing is use the income to cover your expenses, but the carry provides the incentive. And if the carry's not high enough, or if the returns aren't high enough, the carry won't justify or make your economics work. I hope that's kind of got lost in my own thought process there. Okay, you can see the average LBO purchase. It's down a couple turns. It's still prices are still relatively high. If you talk to most LBO players today, they'll say the prices are very high. And partially that's institutionalization. There's a lot of competition. You know, there's 1,000 firms with, I think, over $1 billion today. But what this really says, if you pay this kind of price, and the kind of leverage that you can put on it, you have to create value or grow the company. Financial engineering itself is not going to provide the return you need. Now, if you looked at this chart as an academician, you'd say something's going on. As I said, the loan market just sort of went away. And it's coming back primarily because of the yield curve, and the banks are working through their problems, but that's a major, major change. These are public to private transactions. You can see, again, very, very heavy. These are the big deals, the Texas Utilities, the Hiltons, et cetera, were done. But again, these have gone away. And what we see now is a lot more strategic buyers in the marketplace. So we're competing with strategics in addition to competing among ourselves. Equity distributions of capital are really important to the investor. It changes the IRR, it enables them to continue investing, and so on. And you can see, you know, we were doing great in these periods, and now it's come down. It's very, very, very small. You'll probably see this start to pick up. There's no question that you cannot raise a successor fund if you haven't distributed capital. And probably it's going to be on the order of at least 75% return of capital before you can raise another fund. And if you want your existing investors, I mean, that is essential. I talked a little bit before about how horizons expanded. This is cash flows or equity flows into the emerging markets. You can see while the trends are very positive, the numbers are still relatively small. And of course, the most interest is in Asia, and we still see that. We see Asia is important both in terms of market opportunity and in terms of the interest on the part of investors. But still, it's a relatively small number. Now, we're active in these markets. One thing that we're seeing in Asia is local competition is really picking up. I mean, our problem is not with the Blackstones and the KKRs of the world. We're competing with the local investors, many of whom have Wharton MBAs. They have either direct or tacit state support, and they operate in the local currency. And you may have seen almost all the major firms are forming RMB funds so that you can transact with less restrictions, not totally. And for instance, we have two large funds that are focused on Asia. One is a buyout fund, and the other is a growth fund. The buyout fund is subject to much more scrutiny than the growth fund. But when you see these numbers, say our growth fund, they remind you of what they used to call in venture capital a hockey stick. You know, like the downside is 35% a year. You know, the upside is 60%. And interestingly, they're making it. So the economy, the boom there, it's like the California gold rush. But the competition is increasing, as I said, dramatically. Africa looks like one of the next frontier markets. I think this is a misnomer. I think these are emerged markets, and the emerging markets are Northern Africa, Southeastern Asia, et cetera. And what you're seeing in terms of the buyout funds is you're going to have the very large funds, the KKRs, the Carlyles, the Blackstones, who are going to be global, and then you're going to have the middle market or the national funds who are going to be operate mainly in the U.S. This just gives you a sense in a more systemic way of some of the issues we've touched on. But we've gone through, as you would in any industry, stages. And I'm going to touch on some of these things. We've alluded to some of them, but you've got to see that, and you have all the charts. This is one of my favorite charts. I may need Evan to help explain this to me as we go through it. But what we tried to do was to show what it takes to build a successful fund. And I'm going to spend a minute or two on this because I think it's really important to your thought process. We know that netting 2 times the fund is very, very attractive to the investor. If you can do this in any asset class over a 5-year period, you will have certainly a top quartile and probably a top decile fund. So what we did to show you the dynamics here, and Evan, if there's a problem here, you can bail me out. This is the fund size. You have to get this amount to get here. These are the fees, these are the pref, this is the equity you have in addition to these returning. So you get, if we're going to take 80% of this and they're going to take 20, these are the numbers. And then what we tried to do, these are the assumptions, 5-year horizons, a 2% management fee that compounds, you need an 8% preferred return which compounds, and then a 20% carry. And what we did, we just made some wild assumptions about what you had to achieve in terms of the portfolio to get there. And what this says, this is a plug number, you have to have, well, let me put it this way, you have to limit the number of wipeouts, and you have to have a few investments that return 5 to 7 times your money. I mean, these are probably things you know. We try to do it in sort of a more systemic way. In venture capital, the numbers would be, these two would be very different because you have more wipeouts, you need more big hits. So one of the questions is, given today's prices, leverage, et cetera, can we get this number of companies in that will return 5+ times? And it becomes a much more difficult problem as the funds get larger. So our $15 billion fund, 1% is $150 million. So if we're going to make 30 investments, you can see each one has to be relatively large. You know, as Warren Buffett has pointed out, that universe gets relatively low. So this is a way, I mean, this is kind of a chart worth thinking about in the business. This is really, I call it the billion-dollar challenge. We have to multiply this by 15 for our big fund. Okay, one of the big hurdles facing us is we have a mountain of debt that has to be refinanced in this period. That's a real challenge, and every buyout fund is focused on this. You may have seen, as I mentioned before, Blackstone just redid Hilton. This is really important, and there's a fear because of what's going on with the government that rates may be much higher 2 or 3 years from now than they are today, and you could really hit a wall. So there's a tremendous amount of activity to try to get this taken care of sooner rather than later. And that means attention to the current portfolio versus new deals. Okay, let's kind of, I'm going to walk through now some of the current issues and challenges facing our business. And if I get too depressed, I may turn this over to Dan or Evan to chat about it. But like any business, you know, we're in somewhat of a cycle. And right now, we're in a situation, as are all forms of asset management, where you're undergoing tremendous structural change. And this is true of the Wall Street firms. This is true of traditional money managers. This is true of private equity. I mean, this is I don't want to say once in a lifetime, but certainly once in a generation change. And that we have to deal with a lot of issues that are going to, and some of which are going to take a long time to resolve. Okay, I'm going to go down these. Investment performance. This is our lifeblood. If we can perform at a very high level, we will not be held captive to some of these other trends. I mean, the people that can really perform are not going to have as much fee pressure. They're not going to have as much trouble raising money. And particularly in venture capital, but also in private equity, the difference between the top tier and the top quartile and the third quartile is dramatic. If you look at fixed income managers, there's probably a 20 basis point difference between first quartile and third quartile. I mean, it could be 1,000 basis points in venture capital or private equity. So there's going to be a migration of money to the best performing firms. And we can later discuss, if you want, what might constitute or how you might be a best performer. But this is really going to be important. And it looked like the classroom consensus was that returns in the public market might be something like 7%. Now, it's just illogical that private equity could achieve 35% when it's a semi-institutionalized, very competitive, higher equity positions, higher cost debt, that we can earn those kind of returns. So the question is, how much do people expect and how much can we earn? I think most institutions are thinking of this two ways, the major investors. One is 500 basis points over the market. When they pencil in a return, they think 16 to 18%. If you could return 16% net to your investors, you'd be in pretty good shape. Now, people dream 35, 40, but 15, 16 would be very good, I think. Okay, the major investors in the country have come together as a group and issued a set of principles as to what they should do. Now, there is some belief, which I don't adhere to, that this is a violation of antitrust. I'm not sure the Justice Department is going to protect private equity. But they're talking about fees and terms. Things like fee on invested capital versus committed, huge number. And again, if you play around with these numbers, you'll find out that the carry does not influence their return as much as the fees. Now, can you imagine paying a 25 or 30% fee on private equity? That's the way it works. I mean, let's say we have $1 billion fund, 2.5% fee. So the fee is, Evan, $25 million? Okay, so if we invest $100 million the first year, we're paying $25 million over $100 fee. You have to think about that. But it's a pretty staggering number. If you change that, the dynamic changes dramatically, and big investors figure that out. We've historically collected deal fees. So when you do a deal, you collect a fee. You're really just borrowing from the fund because you have to pay it back, but you have the use of the money. Same with monitoring fees. The pressure on that is very, very strong, is to either return them to the limiteds or not to have them. And there are a lot of other sort of nuances, but the pressure on fees and terms is going to be there. That in all likelihood, funds will be smaller. As I said, our fund was $15 billion. Blackstone's last fund was $17 billion. They've been in the market for about 2 years, and I believe they've raised $9 billion or so. So there's a feeling that smaller funds are better and that mega funds are, at least today, in somewhat ill repute. And we're going to have to hold our deals probably longer, partially because of the markets, but partially because it takes longer to create the value. When you're financial engineering, if the market goes your way, you can do it right away. If we have to create value and build these companies, it's going to take longer. Same with debt, availability, terms, costs, all of which are going to extract a price. We talked about this, shift to value creation versus financial engineering. This is very important. Our industry has become extraordinarily visible. There's a huge push for transparency. I mean, we're much less susceptible to that than the hedge funds because, I mean, we really don't care about trading positions or current information, but we have to be much more careful about disclosure and regulation across the board. I mean, we operate in different states. Our companies all have problems. There are foreign rules, et cetera. And then there's something here that is a very, very important factor for our industry. Are you all familiar with FASB 157? Yeah, it's basically, yeah, guess to market, right? That's the energy and everything and the cost, what that takes is tremendous. And it's had a huge impact on our portfolio. One of the things that investors really liked about private equity was that they didn't mark to market. It showed, even if it wasn't real, it showed a real sense of stability. So you were marking really at cost for a long time, so you didn't get the volatility. Now, and so you had a very low correlation with the markets. Now you have to mark to the market, and most use a period of triangulation to do it. I mean, you look at transactions, you look at free cash flow, you just whatever, you surround the problem and you come up with a value. Interestingly, the limited partners have an obligation to authenticate those values. It's just causing a lot of issues. So we spend a huge amount of time on this now. We have to, the accountants make sure that you have some volatility introduced in the portfolio. So it's having a pronounced effect. Interestingly, these funds, the valuations did not go down anywhere near as much as the market for a variety of reasons, a lot of which they were based on cash flow analysis. Okay, I talked before about the fact that a lot of our traditional investors are tapped out. The CalPERS, a lot of the endowments are not going to be the source of capital they've been. So, but there are new sources of capital developing. The sovereign wealth funds, a lot of foreign banks, whatever. But interestingly, a lot of them have very differing styles. They're very interested in co-investment. They sometimes don't like funds. Sometimes they want side accounts. Sometimes they feel that they should get certain fee breaks, et cetera, et cetera. This is a very controversial subject. I mean, my own feeling is that all the major firms will be public. And we've seen Blackstone is public, KKR is public, Apollo is coming off the Goldman Exchange, Oaktree is on the Goldman Exchange. But I think there are a lot of reasons for that. One is monetization. The partners in these firms, while I think they have no intention of leaving now, certainly feel that they have created brand, they've created value, and there should be some way to get liquid. Permanent capital could be very, very valuable. If the tax laws change to where we're paying ordinary income on limited partner carry, but can invest our own money at capital gains rates, the spread would be quite dramatic. And having access to that, I think, is important. One other thing I should say is the industries consolidate, having a currency to make acquisitions could be very valuable. because most acquisitions in this business, people want a portion tax-free and a portion in cash. So if you have a public currency that nobody has to argue over the value, it makes a big difference. Now, are there conflicts in this? Is this good for the LPs? I mean, we could talk about that for a long time. I think the perception on the part of LPs is this is bad for them because there's going to be another constituency that they have to compete with, that you have to show steady earnings to be a public company, et cetera. This is occurring, the repositioning. We thought of ourselves as an LBO firm, then a private equity firm, and now we're kind of thinking of ourselves as alternative asset management. And this is a natural migration. Probably the best example is Blackstone, which has real estate, they have private equity, they have advisory, they have credit, they have hedge fund funds, et cetera. And this is a challenge which will impact some of you. It's typically the people who ran these firms were investors. But investors never want to turn the reins over to non-investors. You know, it's the eternal conflict. So you have a whole series of issues regarding to how organizations are managed. And most of the major firms, the founders are still there. And when the founders are there, basically they do whatever they want. I mean, you can have committees, whatever, but the founders have a disproportionate influence. But we're starting to think about some of the issues about career development. I mean, historically, when you came into a Carlyle, I mean, you were just, you know, out for a pass. You know, you worked on this, you worked on that. Today, these firms are becoming much more institutionalized. So you might be hired for the automotive group, you might be hired for the healthcare group, but you don't have sort of the range that you might have had. So how do we move people around? How do we develop them? And it's a very interesting thing to think about is the entry-level qualifications are much different than the senior partner qualifications. I mean, most of our senior partners, I'm absolutely convinced, could not Twitter, they don't know Facebook, they couldn't do spreadsheets backwards, but they know relationships, they know deals, they know what the critical elements. How do we take advantage of, how do we develop people to have those skills down the road when we're compartmentalizing them initially? I mean, we don't want basically our people out looking for deals, this and that. And then succession, I think, is something of a Trojan horse because most of the senior people love what they do, and I don't think they have a good situation. I don't think they're going anywhere, but that's something, if you're a public company, you have to address. Are you interested at all in venture capital? We could spend a couple minutes on that. That's a venture, in my opinion, building companies is eternal. I mean, creation of wealth, it's truly an American phenomenon. It has not succeeded in our form anyplace else. Probably the closest is in China, where there are a lot of entrepreneurial companies, but they tend not to have capital come in. The question today has to do with the traditional model. Is the traditional model broken, or has it changed? Is this secular or cyclical? And this is one of my favorite quotes from Bill Parcells: "You are what your record is." Aside from Google and a couple other issues, the record of venture capital over a long period of time has been abysmal. I mean, it's been abysmal in terms of distributions. It's been abysmal in terms of IRR, whatever. And we're now down, as you can see from the numbers I'll show you in a minute, the tourists have left. We're now down to the people who really believe in the religion. And it's a relatively small group, and it's made small by there are not a lot of non-believers, and a lot of major institutions have just figured out it can't impact them. You know, if Penn has a $7 or $8 billion portfolio, 1% is $80 million. What do we get from putting $5 million with Sequoia? A lot of bookkeeping. You know, they're going to invest $1 million a year for us. So a lot of the big institutions have opted out. A lot of other people don't like the results. So you have a dwindling pool, which I'll talk to in a minute, has changed the whole dynamic of venture. This is the way venture kind of works. And this is like an accordion. It compresses and expands. At times, you get all these people are very interested in startups, whatever. At other times, they wouldn't touch them. So now, the only people providing seed capital are the angel investors and what I call serial entrepreneurs. You have a few traditional venture capital firms, the Kleiners, the Sequoias, Benchmarks, who basically see the best deals. They have a network, they see things, they really have a long time doing this, but even them, their record, with few exceptions, has not been great. And then you have the people who like to get on the train before it gets there. And these are various people who will put money in later stage, what they call expansion or growth financing. I guess you can guess what year this was. Happens to be 10 years ago, but that was the dot-com bubble. Everybody loved it. Last year, there was $15 billion raised. And again, I said that's 1/3 the cash that Microsoft has. So this has become a relatively small industry, though you'll see in a minute, there are a lot of reasons why venture capital and entrepreneurship is important to the country. We talked about distributions. This seeded the pot in 50, but look at this now. Last year was $2 billion. This is a real problem. And you're probably aware there have been structural changes on Wall Street that preclude a lot of small companies from going public. We could go into some of the details of that, but believe me, the Goldman Sachs of the world are not going to do a $50 million deal. So you're really restricted to either selling to a strategic or holding the company until you can build it to a critical size. Now, if Facebook wants to go public, or Twitter, they're the exceptions to the rule, but in general, it's a very tough area. Though this is not to say that there are not a lot of exciting things taking place. And this is just a quick list, but there are lots of pockets of opportunity, but they're being addressed in different ways. And venture capital is very important to the country. I don't think there's a diminution of interest in starting companies. We see it every day. They're just being funded in a non-traditional way. But these are companies that all came out of venture capital, and the Venture Capital Association would make the point that they are creating jobs and they've done more than the S&P 500, Fortune 500, whatever. But there's no question that the entrepreneurial spirit, and we see, I don't want to say every day, but certainly 3 or 4 times a week, we see people come to us with a big idea. And they're funding them in very unusual ways. But it's getting done, but it's just not the traditional venture capital fund. I want to talk a little bit about putting our industry in context. This is like a movie we've seen. Banks, brokers, asset managers, hedge funds, private equity. It's really institutionalization, monetization as you grow. And it's a very similar pattern that happens. And maybe you want to try and identify the next one coming, but basically performance leads to growth of assets. You start product line extension, you get a brand, the industry consolidates, you go global. This is a very controversial, as you grow, are you an asset manager or are you an investor? Trading off that. And then finally, you go public or you sell the company. And we're seeing that every day. It's a little harder in private equity if you're a middle market firm. Who's going to buy you? Who's going to consolidate? Clearly, the big hedge funds and the big buyout funds could do strategic relationships or sales quite easily. Let's talk briefly about, finish up with a career in private equity. And some of these I've alluded to. First is we see tremendous interest. Still, we are getting inundated with resumes, not just from MBA students, but from all over the place. And we have, and I think other firms have this too, we have a real dilemma now because the industry is in all likelihood going to be smaller in the private equity area. If our next fund is $5 billion versus $15 billion, we're probably overstaffed today. So what do we do? What we have to do, great firms grow their own talent. There's no way that we're going to capture a top guy from KKR. They're just not going to let him go, and we wouldn't have him. So we have to grow our own talent. So that means that we have to have a more vigorous upper-out policy and continue bringing people in. And that is not easy. I mean, it's a mindset. People in this business do not like personnel conflicts. I mean, our chief investment officer, if I called him with a personnel issue, he'd say, like, I'm out of town, let me know when it's over. I mean, it's just not something that people like to deal with. But these are real live problems that we're going to have to think of. So the appeal and the interest in private equity and our type of investment is very real. We also have to think, how can we move younger people around to broaden their exposure? I mean, can we take a person from our buyout fund and put them in credit? I mean, the Goldman Sachses of the world do that all the time. Say, we don't have much opportunity in private equity, you have a chance to make partner in commodities, people run for the door. That doesn't happen here. So that's going to be a challenge. I alluded to this before, but it's very important. The entry skills tend to be pretty hard. People are looking for, quantitative industry experience. Can they do this and that? Some of those skills do not naturally equate with being a senior partner in developing business, dealing with banking relationships, dealing with high-level professionals, et cetera. And in most of the firms, I think the senior management has abrogated the responsibility of hiring. So if our automotive group is hiring somebody, they have their own criteria. I might have very different criteria. And again, something we have to think about. The funds, you have large, you have middle market, small, all of which have differing characteristics. The career path seems to be that if I talk to people today coming into the business, I mean, typically, they have an MBA. They probably have some Wall Street experience. They would like to come to a Carlyle or KKR, but they're really basically, at the back of their mind, they're keeping their options open. That they're looking, maybe that'll work out, but if it doesn't, maybe I go with a smaller firm, maybe we start our own firm, which is harder today, et cetera. But I think there's a lot more flexibility thought than coming in, I'm going to spend my life here. I mean, clearly this is a very interesting business, a very challenging peer group. You meet a lot of interesting people, even if you're in a narrow discipline. We've talked about career development in the path. The one question I always think about is, if you were joining Carlyle or KKR or Blackstone today, how would you really distinguish yourself? Is it going to be by doing a big deal? Is it going to be by going into a new area? Is it going to be your boss becomes head of the firm? But I think this is something people don't think about. One thing I can tell you is people are not going to be indemnified for having missed 2006 and 2007. You're going to have to make your own way, and I think it's a real challenge thinking about that. And that would be true at the major Wall Street firms, too. I mean, Goldman has, 35,000 employees? So historically, if you think, how have people truly gotten ahead? I mean, there are a lot of people who say, well, they're smarter, they work harder, et cetera. I mean, typically, those are attributes that most people have. I mean, what is it? You join a firm early, you get into a growth area early, you get lucky on a big deal or whatever, but there's some dislocation that happens that gets you moving. And I think that's something everybody has to think about. I put economics last, not because it is last, but because that's not the primary factor. I mean, I think in most careers, if you do well, the economics will follow. I think the economics in this business are going to deflate a little bit. They'll still be very good, but it's not the driving force. I just listed I'm going to give you these are two very well-known people that have listed their rules of investment. I'm not going to go through them. Bill Conway, who's our chief investment officer, who gets very little, he doesn't like publicity, only focuses on investments. He listed his own thoughts of what. You can ponder these at your leisure. And then there was a very well-known fellow on Wall Street, Bob Farrell, who had 10 rules that he thought about. He was, for 25 or 30 years in a row, he was selected as the best technical analyst on Wall Street, et cetera. So I think with that, I'll finish up on the formal, and if there are things you'd like to discuss or issues you'd like to raise, I'd be glad to entertain them. That's a long time to talk. So any questions, problems? Yes.
Yeah, thank you for the presentation. Carlisle has an infrastructure and a power fund.
Yeah.
And before in 2006, 2007, people used to think that these assets were recession-proof because they were vital for the economy, and they put a lot of leverage on those. So I would be interested in knowing what happened to those investments and if it's really true that they fared well in this.
Yeah, I really have to disaggregate that question because we do have an infrastructure fund, and a lot of other firms do too. That's a relatively new area. The way in which private equity is migrating is different from what we did in the past to some extent. If you take financial services, historically, we always had assets under what we did. Financial services doesn't. You know, we call it the financial group. Infrastructure is so intertwined with government agencies and how you get the fees and what type of returns and leverage. I don't think we have enough experience yet to know in the infrastructure area. What it does look like is the deals are priced not to provide a great return. And what we're starting to see is a lot of interest in the emerging markets, in international infrastructure, which offers maybe higher returns but probably more risk. Power is very different. We have an energy group, Riverstone, which has just been spectacular. Their funds have returned 3 or 4 times the capital. And that area, it's a huge area, it's very relationship-oriented, tremendous amounts of activity, and that has done very well. Alternative energy, which everybody likes, has not done as well. And I think that's what you may have been alluding to, that these are very tough. When you start making wood pellets or ethanol or whatever, these are very, very tough businesses. And there's a lot of interest in green and environmental, but the returns so far haven't been there. I don't know if that answers your question. Yes?
If you look at the kind of the area of the private equity timeline that you referred to as the golden age,
depending on whose perspective, yeah.
When did you first realize that that was kind of coming to an end? And what was your reaction of what you and Carlisle, broadly speaking, needed to do to...
Our Chief Investment Officer, Bill Conway, wrote a sort of prescient analysis sort of as that was coming to an end. So I'd say, did we recognize that there were problems, et cetera? Yes. Did we do enough action to take advantage of it? No, you never do. I mean, there's no way if you're managing a big pool of money, you can go to an extreme position. I'd say we did better than most, but even having recognized the underlying problems, slowing down our activity, you could have done a lot more. I mean, everybody kind of saw the excesses, but it was like a narcotic. Yes?
You talked about if you join one of these firms today, how do you distinguish yourself?
Mm-hmm.
And do you have any thoughts as to if you're one of us in the room joining one of these firms?
Yeah, I actually do. I'd say the first job is you may have to disguise some of your personality to get the job. That I think you have to kind of, things come up all the time, and I think you have to be prepared to take some chances. You know, let's say, like I'll tell you a couple suggestions that I've made at Carlisle to various people. I mean, we're fairly active in telecommunications, defense, retail, et cetera. I personally believe that agribusiness is going to be a very big area. So for a young person to say, go to the head of the LBO fund and say, look, I'd like to learn something about agribusiness, if you're right, all of a sudden you become a team leader. You jump over a lot of people who don't know anything about agribusiness. That type of mindset. I'll give you another example. We're thinking of doing some more things in asset management. That's a fledgling division for us. Maybe leave the buyout group and say, I'd like to help build this division. There won't be a lot of volunteers to do that. I mean, most people feel that everything's going to work out great. You know, I'm a member of the automotive team, and if I stay here, I'll be running the firm and get all this. It's not going to happen. So I think what you have to do is at some point, you have to take some type of risk to differentiate yourself. You know, whether it be go with a small firm, whether it be to kind of try and develop a new area, whatever. And we don't see much of that. Maybe, I don't know if I have another one. I mean, most people say, boy, I'm working on a $15 billion fund. I don't want to go to something that there's nothing going on. Yes?
You briefly touched on the ILPA sort of consensus.
Yeah, by intent. That's the consortium of investors that is trying to change the industry.
Do you think that that is going to be a real change, or is that sort of, as things went down, well, there was a brief transition to LPs having power, that's more of a flash in the pan?
I don't think it will happen in the extreme, but I mean, you could say they're jumping to the front of a parade and pretending they're leading it. Some of the issues that they're talking about make sense. The buyers clearly have more power today. And I think people, where it's sensible, will accede to some of their issues. I mean, they have certain issues that we would be crazy to give, like, can the limited partners put you out of business? I mean, that's sort of non-negotiable. They know that. Should you change the fee structure, some of the terms, that'll get negotiated out. So I think these are trends that are inexorable. They're going to happen, not to the extreme, though. Yes?
How does so you mentioned how the industry is I'm not able to say the word. It has gone through different stages. And you mentioned a point about how there might be consolidation happening in the private equity industry.
Yeah.
Could you talk a little bit more about that? Because it has been such a cottage industry, and different people, like most often they want to break away and form smaller companies rather than consolidate.
Well, it's not either or. I mean, there are always going to be people that are entrepreneurial, will go off and do their own thing. Today, it's much harder to raise the money. So, not that it won't happen. I think in terms of consolidation, there are firms that will want to be part of a bigger organization that have access to capital, have access to marketing. I think there are a lot of firms that will not get funded again. A lot of people were at the periphery. The CalPERS, I think, has something like 275 private equity firms. There's just no chance that they're going to fund every one of them. So the consolidation is going to take place in that way, but I think it's inevitable. I mean, and it's really unwinding what happened in the glory days. And someone once equated these funds to nuclear waste. They have a half-life, every year. They go on forever. But they're going to kind of sweeping them up. Limiteds are going to say, I don't want to keep paying the fees. They'll get a vote. They'll stop it. So it's going to be sort of a war of attrition. I think the bigger firms they'll be consolidating, not consolidated. Yes?
I have a related question, and on page 39, you talked about the natural progression.
39, okay. Now I'm really getting comfortable with this, yes?
So what's next? Is it going to be sovereign wealth funds? Is it going to be investing conglomerates? Is it going to be more sector-focused or geography-focused funds? Is it going to be currency-focused funds? Where's the money going to go?
Well, of course, this gets back to the question you had. There are always going to be opportunities, whether it be currencies, ETF funds, whatever. I think what I was really talking here is the major firms in the industry. It's a pretty typical pattern. I mean, they create tremendous brand wealth. And let's take, for example, KKR. If you think KKR was worth $10 billion and Henry Kravis and George Roberts, let's just pick a number, own 50%, then somebody has to pay them out these numbers sound ridiculous, but somebody has to pay them out $5 billion. It's not going to be the junior people in the firm. Now, they may say, this is great. Why don't I just give it to all the junior people, and we've had a great career, and go on. I mean, I would take the other side of that bet. But so I think monetization and some way to get the value of what you've created and to build a more enduring organization is just inevitable. I mean, a lot of the small firms are not going to have any options, really.
Do you think private equity firms can have competition from sovereign wealth funds?
Oh, absolutely. Yeah, the question was, we're seeing the sovereign wealth funds basically have tremendous capability to invest. And if one of these funds invests with you, they send some people over to learn the business. They like co-investment. They'll put a certain amount in, but they want to be guaranteed co-investment. Yes, I think there's no question about that. They're very sophisticated investors and becoming more so. Yes?
I want to come back to my colleague's question, but being specific, if you work in a fund that just has one buyout,
one focus, and there is no room to go in a high growth area. What are the things you need to focus on in order to progress, and what are the partners look in terms of personal characteristics that make an associate or a VP kind of someone who is looked upon as a potential successor for kind of someone who is leading the firm and being groomed?
Well, you know, in the situation you described is a very tough situation, because if there's no growth, you basically freeze in place. And the senior partner has two questions: get rid of the guy in the middle who's costing them more and promote you, or just sit with the status quo. That's why firms, when they reach a certain size, tend to diversify and do different things. But a stagnant situation is not good for career development. I mean, there's just no question. I mean, there's no way to get around that. So I guess the answer would be start thinking and looking. Yes?
I was wondering if you could comment on generalist funds versus industry-specific funds, and if that's just a natural evolution, so as funds get larger and larger, they need to be industry-focused.
I think more and more we're seeing the need to be specialists. Even for small funds, they tend to be medical or bio or industrial. I mean, these are complex deals, and interestingly, some of the smaller deals are harder than the bigger deals because they don't have the infrastructure, and they don't have the accounting systems, and they don't have the information. But there's no question there's a tremendous focus on specific industry knowledge. I mean, I have a hard time thinking of anybody that's just out for a pass, you know, just will do anything. Now, having said that, our fund in Asia is industry agnostic. We have a very successful Carlisle Asia Growth Fund. They will do anything. Any type of format, any type of industry. And their thought is, we're betting on entrepreneurs, we're betting on growth, the industry knowledge is secondary. So I think it's a little less important in the emerging markets, but clearly having industry expertise is a plus. The question is, as a young person, if you develop industry expertise, how do you either get out of that or take maximum advantage of it? To some extent, huge industry expertise is more valuable to an investment banker than it is to a private equity investor. You have a lot more options to make money.
But is the LP community also looking for that? So they prefer funds which have an industry focus, or are they more?
Well, the flow of money is clearly to broad-based funds who have an industry focus within. I mean, industry-specific funds typically are not that big. Though, you know, Providence has a media bias. I mean, we were looked at as a defense fund, but, you know, KKR has certain, but typically, if you go out and say, I want to raise a fund to do media deals, it's much harder. I mean, it's just not a lot of interest in that. Yes?
So, which, you were talking about developing some industry expertise, so which industries would you say will be attractive within the next 5 years? You mentioned agriculture, agribusiness as well.
Well, you know, the industry I think is hugely interested is energy. I mean, there are biases against people doing energy. I mean, if you say to somebody, you know, on Wall Street, do you want to go into banking or do you want to go into entertainment? Yeah, great. You want to go into energy? No. So I think energy is a huge area. There's a huge number of transactions. I think more and more private equity firms will go in that area. So that's one. I think agribusiness. I don't know if I have any other sterling insight. Yes?
My question is on emerging markets. Given the fact that debt financing and buyouts is still a regulatory burden in a lot of countries like India, how do you see that impacting the growth of buyouts in India or emerging markets? And what is your company's strategy in such markets?
You know, I think the traditional LBO market model does not work in the emerging markets, to make a long story short. I mean, typically in India or China, we're doing growth financings. And once in a while, you can get some debt, but it's not big. I mean, it's a different mindset, a different way of doing deals. And the lack of debt is offset by the high growth rates. I mean, but you do not get the kind of leverage. And like in our China Growth Fund, we do no leverage, zero. But I'd say, what did you say, Evan? The average growth rate's 50%, 55% a year. I mean, you look at if this were in the U.S., you'd throw it at you. You'd just say it's never going to happen. But, so I think the model is different in the emerging countries, and it's much more equity-based and high growth. And as you know, in India, the real issue is governance between families because most of the companies that are doing the deal are family deals that want expansion capital. Yes,
So you're saying about a challenge to have bigger funds, and how do you see this as a barrier for the Carlyle Group? So today you have almost $90 billion in fund in 27 office. What do you see this as optimal size for your group, and how do you see this coming forward?
Well, you almost have to look at it by sector. I mean, if in the credit area we could grow exponentially, the markets are just huge. In the U.S. buyout area, I think the funds are going to be smaller, and we see tremendous growth potential in some of the developing or emerged or whatever you call them, Brazil, India, China. Those funds will, I think, be bigger. So you have to look at it sort of individually. I don't think there's.
And this consolidation, you're saying, how do you see this actually happen? If you could explain, do you see Carlyle buying any other fund, or you see just the LP concentrating their money in a few funds?
Well, I think the biggest factor is a lot of funds will shrink dramatically or won't get funded. I think there are other people who will try to affiliate with someone who can help them. I mean, Evercore, which is a public investment bank, in the last 2 weeks bought a placement agent, bought a fund of funds, and they bought they bought a traditional money manager, and they bought a private equity firm. And they're betting that they have the synergies or something. So I think you're going to see attrition, you're going to see some affiliations, you're going to see some purchases. This isn't going to happen in one day. It's just a erosive pattern. Oh, yes?
You mentioned, and I've heard this a few times, the sort of the momentum to specialize, or not the momentum, but the tendency to become specialized. And what do you think of, I guess in that sense, of the value of an MBA? Because here we're actually going in the opposite direction, which is non-specialized.
I should ask the professor to leave the room. There's been a lot of studies made of what people really feel they got from their MBA, and one is the credential, the other is the relationships they made, and the other is the thought process. I personally am a big believer in that.
Well, I think everyone.
It wouldn't suit me to be pigeonholed, in a very narrow job. And so the question, you all have your own proclivities, but the question is, how do you get out of that? I mean, step one is, how do you get into a Carlyle, KKR, however you want to get into Goldman? Then the next question is, once you're in there, how do you distinguish yourself and kind of develop your own career? But for some reason, outstanding people stick out. I mean, I could tell in our company 3 or 4 people who are very young that have come to the attention of top management, and eventually something will happen. Now, we could go through why is that, et cetera. But it happens, and you get on a fast track very quickly. Some it depends who you work for. I mean, in my opinion, we interview a lot of people. I'd say most of the people, I don't know if you want me to get into it, but I'll give you an opinion on it. Most of the people who we interview, in my opinion, have their priorities wrong. Because they want very specific, what would I be doing, this and that. And the real key questions are, one, who am I working for? Is this a person that's going to develop me or hold me back? Is this a person that has influence in the firm? And then secondly, the more, in my opinion, this is my own personality, the more specific the job, the worse. Would you say, Evan? That's yeah. Now, Evan works is with us. He deals with every one of our senior partners. That's his job. That's a good job. Yeah. Why should he go to business now? But it's because of what the job is flexible. When he came, he had no idea what he would be doing. And we hire other people. So you're going to be in the automotive group, you're going to be in the health group. And a lot depends, is the area hot? Like healthcare, anybody that looked at our business today would say, you should put more resources in healthcare. Okay, we have a small healthcare group. People should be jumping to get into that. Now, your boss tries to stop you, et cetera, but that's the kind of thought process I think you have to have. I don't know if that answers your question. It's kind of a, yes?
What are the problems with private equity as a young professional is that it's a relatively useless skill outside in the real world. In the sense that you're valuing companies, you're doing earning models, you're doing real processes, but you actually don't know how to do anything. You don't do sales, you can't do a CFO's job, you can't be CEO.
Yeah, I don't see that problem. I think you've identified the problem, but you have the wrong analysis. The real problem I would see is that there's a gap in terms of what compensation is in private equity, but you might get in a comparable position. I mean, do our people have the skill sets and whatever to operate in Procter & Gamble corporate? Absolutely. But for whatever, there's always saying in the Navy that pilots get paid faster, not more. To some extent, that's true in private equity. So our person 5 years out of school might be way, way ahead of a person at Procter & Gamble or IBM, and in their own mind, to make that transition would be very hard. They're going to have to learn to live with it, some of them. But I think that's more an issue than the skill set. And because, I can look at our hiring process. We basically hire really top quality, motivated people who will be successful at our firm or someplace. So I don't agree with your conclusion. I agree with it's a problem, but I think it's almost all economic oriented or not wanting to move geographically.
Where I was going with this, would you recommend that of your young professionals actually then working with some of your portfolio companies?
Yeah, well, I was going to bring that up. One of the things, if we go more into growth investing, if you see a situation where you could go into the company and be a senior person and be a player right away, that would be a very interesting option. We had an interesting thing come up with one of the firms I'm involved with where a young person is an expert on storage. And he's a junior person, the company doesn't have much influence. What he thought was that the biggest idea he's seen offered him a position to be CEO or COO. That's one it looks to me like he should take. He's got the expertise, he's going to break out of the pack if it works, and he's got storage knowledge to get another job. But people don't, for whatever reason, they see that's pretty risky. Yes? I didn't mean to get into career development. I don't know. This is a challenging question, but it's a key issue for us.
Just another follow-up question. I think it's pretty common that in private equity shops, once you become an operation person, you'll be no longer viewed as a deal person. I think that's probably the reason holding back people from doing deals.
Well, that gets back to my point about risk. If you really think about it, it's illogical that a person could be good at finding deals, structuring deals, managing the fund, managing the deal, and exiting the deal. They're four disparate skills. Now, people think they're Renaissance people that can do it all, but it's not. And so I think your point, more and more we're hiring operational people. Like Carlisle was extremely well known because we had a lot of these political people. Today, when we add senior people, they are really have run companies. We have Lou Gerstner with us. We have John Brown from BP. We have Charles Rosati, who ran the IRS. So the emphasis and importance of operational skills is there. It may not be as glamorous. But you have to make your own decisions in doing that. Most people would agree with you. Say, I'm a deal person, I can't be bothered. But the real need in the firm may be elsewhere. And it may be you'd have to go with a company. Yes?
So you mentioned about how there is so much negative press on private equity.
Some negative. It ebbs and flows. We don't get as much as Goldman.
No, I was just curious why, as an industry, we have not taken a more proactive stance on pushing positive PR in the industry. Like we should, rather than, I don't know how many positive articles we have seen.
Our industry would take umbrage at that. In fact, would say we have. We formed a private equity council. The companies have come together in an attempt to do some of this. But, sometimes you just can't change the news. Some of the things that people have written about and talked about and the unions are after, it's just a fact. You have to deal with it. And I think we've been fairly proactive. I don't know if you've seen, but Carlyle and KKR have come out with green policies. You know, we're doing charitable things, trying to help people get in scholarships. But, you know, we're really an infinitesimal industry. You know, when they're talking about Citicorp or Citigroup going under, and, you know, whether we're doing something, and I think it's not, you know, these stories run their course. I think private equity is coming out of the news. I mean, maybe we'll come back someday, but it's just not as much going on. We don't have as many problems. Well, I appreciate it very much. Good luck to you all. Yeah.